welcome to another exciting episode of Finance Footnotes. I am your host, Brent Stransky, joined as always by my friend and colleague Zach Miner. Today is February 12th, Wednesday. We're going to be talking about some exciting things about the markets, and then Zach's going to end with some comments on inflation. So jumping right into things, as always, I have a chart here talking about what's going on in the markets. And as always, I pulled the three primary indexes from the Wall Street Journal, and I wanted to point out the Dow Jones, the S&P, the NASDAQ. And, Zach, I kind of forgot that things have been really steady or kind of flattish for the last 3 months at least. So I've got a red kind of dotted line here indicating that the S&P has been treading water since, I guess early December. So yeah, just
Yeah,
about 3 months.
banging up against that range. It is, you kind of look whether you're making higher lows or lower highs, and it seems to be that you're making higher lows, kind of. It's not very that clear. Um, yeah, we're kind of just consolidating, bouncing around, kind of a range bound type of period, which I think is at least what I kind of expected going into this year with a lot of the policy uncertainty.
That is what you would say, seeing as you're expecting lower returns so far this year for equities. I maybe think it's a consolidation before another leg up. We'll wait and see. We'll have to wait to the end of the year and see. All that to say, we're still within about 1% from all-time highs, depending on this is as the close of day yesterday on Tuesday. So I wanted to start with kind of what I would call like a primary. Yes, that's the word. A primary thought here as you're investing or going through life in general, right? And so I'm going to start with a quiz for you, Zach. And the title of this slide is "You're Wronger," and that's not you, Zach. That's all of us. So you may have heard this famous study, but for a few folks at home, there in 2019, AAA came out with a survey and they asked folks, "Are you better than the average driver?" And so, Zach, if you don't mind, what percentage of drivers say they're better than average?
4 out of 5, three
Yeah,
quarters.
yeah, really, really, really close.
I'm in Pennsylvania, so for folks in the Northeast corridor, we think we're better drivers than
100%.
everybody. And
No, for
so,
sure. So this is that's true. 75% of all drivers, and what percentage of men think
oh,
they're better than
every
average?
single one, every single
Yeah, you're right.
90
Your
plus.
first guess was right. 80% of men think they're better, according to the survey, which there, as statistics go, there are some reasons to question that data, but that's not why we're here. We're trying to make a point that everyone thinks they're better than they are. So I want to say that because this article came out in the Wall Street Journal this weekend. I thought it was very interesting from Stanford University talking about the Dunning-Kruger effect, aka the overconfidence bias. So of course the Super Bowl was over the weekend. A lot of folks making money, a lot of people losing money, either on their number of Taylor Swift appearances on the broadcast or the spreads. But I thought this was very interesting, right? So they asked the group of bettors who were willing to share their data, like their online betting data. 91% of those bettors were overconfident about their outcomes. In other words, something like they expected to have a return of 30% and they ended up um, being much worse than that, as you'd expect, right? You're a casino. They don't keep pumping it full of oxygen and cocktails for free, right? And then I thought the second part was funny. So 91% expected better outcomes than they got. And maybe this is sample bias, Zach, maybe not. And then at the very end, there 9% had better outcomes. And I think that's how the casino industry stays alive, is by giving some outcomes to better outcomes. So these people may just have been lucky. But I think we can, without too much risk, and I think this is what Wall Street Journal was doing, is carrying the same idea over to investing, right? People tend to be overconfident about their stock picks, and very few people actually track how they do, so they can't confirm that bias. Um,
Right.
I love nothing makes you sound more smart than quoting the Dunning-Kruger effect. I want to point this out in a place I think is particularly evident, and this is a chart I found this weekend from one of my favorite commentators, Jared Dillian. And so he's looking here at inflation expectations and how they diverge based on your political leaning. Okay. And this is so interesting. So you see this data goes back 10 years, but they started splitting it up maybe 5 years ago to include how Democrats, Republicans felt. And you can see here that that red line, and this is inflation expectations, starting with, Trump's election fell off a cliff. And in fact, the forward expectation of inflation is zero. At the same time, as you'd expect, Democrats expected change skyrocketed to over 5% expectation. Boy, isn't that crazy, Zach?
Yeah, that's a microcosm of the sign of the time. That's just how politically divided we are and how it filters into everything.
It really does. And I think you'll talk about this later, but the expectation for inflation was released today, as well as the inflation number, and that has nudged upwards. But it seems, at least from this graph, that it's mostly related to expectations of politics. So the last thing I want to mention here today, and I only had a couple short thoughts here for you, my friends, but I want to continue with the optimistic take. What are we expecting from equity markets for the remainder of 2025? And I want to highlight one interesting data point. And the idea is, this is from our friend Ryan Dietrich at Carson Wealth. He published this last week. And it said since 1951, when the S&P 500 index is up 2% or more in the month of January, what about the remaining part of the year? And as you can see here from the data, it seems like there's about 30 observations. So this is a pretty good data set, Zach. And up a full year 88% of the time, which is much better than average, with a 19% median return, okay, over that period of time. Pretty good, Zach. What did you say?
Yeah, January effect.
The January effect.
As so goes January, tends to go the rest of the year. There's really only been those, 4 times, and one of them was basically flat, or two of them were basically flat. So actually only two really actually negative years out of those, 30 or some odd observations.
Yeah, I guess the last one, 2018. So, and then up 11 months, the next 11 months, February through December, 84% of the time, still very attractive, still very good returns. And all this to say that I know the January effect, it tends to be good momentum for the market going through the rest of the year. And I think there could be, evidence to support my thesis from 1 month ago that markets will be up 80% chance markets will be up 12% or more in 2025. Zach, you had a
Love it.
slightly different take. Do you want to take this opportunity to maybe adjust are you going to stick with it?
No, I'm sticking with it, and I think that we'll talk a little about why just in the next couple slides. And so I want to talk a little bit about inflation because that was kind of the big story of the day. Sent the Dow down about 400 points, even though it did rally back off those lows
Right
and
now.
a couple hundred.
Oh, yeah. Okay.
Nasdaq's actually positive at the moment. But this is kind of, I think, the main risk for the market right now is a resurgence of inflation and potentially accompanying about face that the Federal Reserve might have to make. And I think it's baked in that they're going to pause interest rate cuts, but if they have to come back and raise interest rates again, that clearly would not be good for markets. And it's pretty clearly reaccelerating. We've kind of broken out of the high 2.8% range back above 3% when it comes to inflation. Now, over the last couple months, this was a particularly hot reading. It was 0.5% this month, which was 5.7% annualized. Pretty heavy inflation in the January numbers. But I do think it's important to look at it in context of the full, last 60 years here at this first chart. And, we're at 3%. It's not particularly high relative to where we've been in the past. I've said I'm on record that we're going to raise that target at some point from 2 to 2.5. I still think that it will eventually happen due to structural geopolitical issues and supply chain issues and good economic growth and all of those things put together. So I do think that they'll eventually raise that target. It could be quite some time before they do, but we can just see that it's just sticky. We're sticking around this 3% number and a potential for reacceleration, because if you look at that core excluding food and energy number, that's actually higher, 3.3%. And that's kind of the core inflation numbers. So looking at the next chart here is going by component of inflation and what exactly was driving the increase this month. Now, there were a couple one-off things that are not market and economic related. The bird flu was a big one. Drove the price of eggs up 15% in 1 month. Price of eggs up over 50% over the last year. And so that drove a lot of the food price inflation. But if you look at core inflation, it strips out food and energy anyway. So that doesn't tell the story there. Shelter inflation is still very sticky. You can see it down on this chart. It is only, rent of primary residence, I think, is the only one on here, 0.3%. I think the owner's equivalent was 0.4. So it doesn't look like a huge increase, but it's a big component of the overall index.
Yeah, I'm
So
just
it's
looking at the index here. Video discs and other media up 20%. Um,
yeah,
and it's so funny because obviously no one's buying CDs anymore. But I don't know if you got this message, but Netflix did increase their price
they did.
by something meaningful, like
Yeah,
20%,
couple
$2 a.
bucks,
So
couple bucks.
I
Yeah,
wonder if that's hitting the data. And you heard it here first on Finance Footnotes, folks. Netflix
yeah,
adjusting the January inflation numbers.
yeah, absolutely. You know, used cars and trucks, motor vehicle insurance, meat, poultry, fish and eggs. So it was pretty broad based. There wasn't too much that actually decreased. And so we're just seeing it stick. We're seeing it stick around this 3% number. And the accompanying Fed funds rate futures projections is the next chart here. And the market is basically saying maybe we get one, in the
Mm,
year. That's kind of where the numbers have moved to. I would not be surprised if over the next couple of days it further shifts. If we start to see no, October and December start to come off the table, and then it's basically like we're not getting a cut this year. And if you remember, we were 4 to 6 months ago, it was like 4 or 5 cuts this year was the expectation, right? I mean, we were ready for another 100 basis points of cuts, and now we're looking like maybe one, maybe not at all. And that I think that's okay for the market. I think if it signals economic strength, growth is still good, earnings still good, unemployment still good. I don't think that's a necessarily bad thing for the market. The really downside scenario would be if they have to turn around and raise rates. If inflation goes back to 4.5, we just see it reaccelerating, and they actually have to
mm.
say like, we were too early on that, and that is exactly what happened in the 70s. So you kind of get back to those corollaries, back to that time period where they cut too early, inflation reaccelerated, they had to turn around and re-raise them. And then you were kind of in that cycle for a while. So, we're not there yet, but it's definitely moving in that direction, away from kind of inflation falling to 2%. Everyone, we can cut back to a neutral rate and everybody's happy. So that is starting to change that narrative a little bit. Um, and switching a little bit of gear just to the another potentially inflationary and economically dubious thing, is the impact of the tariffs that the president has started to wield, pretty liberally, among both adversary and ally alike. Now, only the 10% additional Chinese tariffs look like they're actually being implemented for sure. Everything else has been talked about and delayed and pushed off. And, even the 25% steel ones are, maybe going to get delayed. We'll see. So you don't know how much of it will actually be implemented. But JP Morgan did a projection of what the kind of the announced things and the threatened things could do to earnings per share of the S&P 500. And it's significant. If you put a 25% tariff on Mexico and Canada, that's $13 of EPS earnings, which is essentially the entire growth for the year on EPS. So, and will it end up being that much? Because, companies are pretty good at moving supply chains and augmenting certain things to mitigate the impact of some of this stuff. Looking for different suppliers or using some loopholes or exceptions and things like that. But it won't be zero, right?
Hmm.
There will certainly be an
It's not going
impact,
to be accretive.
right? It's not
Well,
going to be
actually, I
accretive
mean,
for sure.
yeah, I guess that's the debate, right? All things, net all things, maybe it would be accretive at some level. I guess that's the great debate. JP Morgan is saying, uh, not so fast.
Yeah, and I think that's you could look at it on a could it be accretive on a long run basis? Maybe. I think
Mm.
it's pretty clear on a short run basis. It's going to be deleterious is the operative
Ooh, I like it.
accretive.
That's a
So,
$5 word, buddy.
and so you kind of you put all those things together, and it just clouds the picture. And this is really exactly why I was not particularly uh, positive on the year to come. It's just a lot of these things are just introducing uncertainty, and it's not necessarily bad everything. It's just It just clouds the picture. And if we, like we said, if we're not going to hit those earnings per share growth bars that we've pretty much priced in, the market will correct because we've
Hmm.
basically, we pulled forward some of that price performance to say we're going to hit those numbers. So that's what I think is important to note. But the next two slides are, I put a question mark at the end of inflation comes in hot, because is it? So there's two things that you kind of look at that maybe indicate that it's, I don't want to use the word transitory. Is that a red letter word with the with the Federal Reserve? But if you look at S&P 500 earnings calls and CEOs kind of mentioning inflation, that has significantly dropped. I mean, that's almost down to zero. It's very much back to pre-pandemic levels. Really not being mentioned much on earnings calls this season. Now, could that resurge and you could hear it again? Maybe, but at least as far as corporate CEOs are concerned, they're not really talking about it. That's not something that they're pointing out as a potential impact, to their businesses in 25 and 26.
Interesting. We could certainly hope.
And then the final one is Trueflation, and this is a newer kind of tech platform. It utilizes blockchain. It collects data from 30 different sources, including like Walmart's online shopping prices, Zillow, Amazon, and a number of other publicly available real-time pricing indicators, and creates this what is supposed to be a much more accurate and more current representation of inflation in the marketplace and the economy. And so far, it's been pretty good. It's been pretty accurate. I think we've highlighted it a couple times in the past, especially back in late 23, early 24, when it was showing that inflation was falling ahead of CPI, and we were kind of using that to say it looks like the CPI will follow, and it did. Down from the kind of the highs of the 5
This
six
is a great
percent.
chart, Jay. We have talked about this chart before, and I love the kind of real-time data set. And we talked about it like end of last year, and then I noticed
Hmm.
that towards your end, it did creep up back above 3%, which
Yeah.
was worrying, but maybe accurate based on today's data. And then, dang, just fell off a cliff like towards 2%. Like that's a pretty
Yeah,
seismic
really,
move.
really interesting. And you could kind of look at perhaps the delay in CPI, right? Maybe the trueflation was actually peaking back above 3%, which is where CPI is today, back in, November, December. And the actual CPI is a few months, quarter late, to
Mm,
reporting that. And so
hmm
if you follow that all the way through, then if Trueflation is giving you that real reading today, well,
If
then
what, yeah, if what this
then
data is telling me,
right.
Zach, correct me if I'm wrong, egg prices are going down. That's the good news takeaway for folks at home. If inflation is accurate, we can expect egg prices to finally go down.
Yeah. And you should also expect bond yields to follow that. And there's a pretty tight correlation between, the 10-year yield and the trueflation number. So, I'm always looking at those bond yields as being a very kind of good indicator of, where the stock market's going to go. And if we creep back
Mm,
towards 5%, it's not good for the stock market. There's no way to paint that as being good. 4.5, 4.25, I think is fine. We would like to see it trend towards, four-ish, for equity market prices. But I think this is an interesting, different way of looking at potentially a more accurate and current picture of inflation. And you just take some of the, you put a little blanket on the fire. It's not yet not too crazy, too bad. Don't overreact to a 1 month significantly high print. So we'll keep an eye on this and see if this ends up being an accurate forecast over the next quarter or so of what CPI
yeah,
will do.
that's great. I mean, for folks looking to lock in rates now, if rates are dropping, if they do follow that inflation number, like you said, that's really good information to have.
Yes, sir.
All right, my friends. Well, that's all we have
Quick
for
one
you.
today.
Yeah, quick and painless. And I hope you had a wonderful time, um, folks, and survive Super Bowl weekend. And we'll catch you next time on Finance Footnotes.